Hello, and welcome to the Mid-Year Economic Update and Investment Review. As most of you know, we typically don't do a review in the middle of the year, but given all that's going on in this environment, we thought that a special edition was in order. I'm Haleh Moddasser, and I'm joined today by Dennis Stearns, PJ Williams, and John Thomas, all members of our investment committee. Welcome, gentlemen. Thank you for joining us. So let's get started today by looking at year-to-date performance. As I'm sure you all know, it ain't pretty. Starting down at the very bottom in the orange in the year-to-date column, you can see that small cap stocks are down over 20%. And scrolling on up, you can see that pretty much all equities are down across the board. The only thing, in fact, that's up are really commodities. Cash is marginally up, but is being eaten alive by inflation. And commodities are driven primarily by wheat and oil prices resulting from the war in Europe. What's different, however, we've had years like this before, but what's different this time is that our fixed income numbers are down as well, 9.5% year to date. Looking at the next slide, we can see that this is actually quite the anomaly in the history of fixed income. The dark bolded line will show you that we're down, 10.4% on this. The high was in 1995 at the very top, over 19%. And the last low that we had was in 1999, which was under 5%. So we believe that this could potentially be driven by an overreaction to expected Fed rate hikes. But it doesn't really feel good for investors when we have high inflation, low stock markets, and a bond market that isn't cooperating. So looking at the next slide, Dennis, welcome. Talk to us, if you would, please. Do you think these expected rate hikes have now been built into the bond market? What do you see as the forecast here?
Well, thanks, Haleh, and welcome, everyone. Absolutely, much of the rate hikes and then some have been built into prices. There was a classic overreaction, what we call a taper tantrum, taper being the reference to the Federal Reserve policy of pulling in some of their easing, tightening, another way to put it. And this taper tantrum was a doozy. And so what we've seen actually in recent weeks is some lowering of that tantrum. The child is not wailing quite as much. And so bond yields have actually eased back some.
Well, let's hope so, because generally there's a flight to safety when equity markets are down, and we would expect bond prices to go up, but clearly that hasn't been the case at all. What is our current allocation, if you would please, Dennis, to bonds in our portfolios now?
Yeah, well, it's less than half what would be normal for our benchmarks. And so we have been radically redoing bonds. We had one of the more major redos a couple of years ago in our bond portfolios, and then have redone them again. And so again, the question is, what's the ongoing role for bonds, if any, in portfolios? And, I think this slide is a good one to think about how even in this environment we're in, they are less volatile, likely to be less volatile going forward. And again, Defense Exhibit 1 is the last 2 weeks, is that stocks have been more volatile and down, and bonds have actually stabilized and in some cases been up, even though the first quarter was pretty ugly for bonds.
And I'm thinking we expect this trend of less volatility to continue once we get beyond the Fed rate hikes. Would you agree with that?
I'd agree with that. I think the fear in the markets right now is that inflation is so difficult that the Federal Reserve policy has to be a Paul Volcker type of response. Paul Volcker came in the early 80s as Federal Reserve Chair and just cranked interest rates up and did everything but the kitchen sink, throwing it at inflation to get it under control. It was a little bit like chemotherapy. He almost killed the patient. We had double dip recessions, for those who don't remember 80 and 82. And interest rates did come down, inflation did come down. And there's a fear that the Federal Reserve is going to have to do that again. Again, we share concerns around that, but we don't think that's the most likely case going forward.
Well, thank you for that. We'll keep our fingers crossed on us. Let's turn our attention now to the other elephant in the room, which is inflation. Clearly, inflation, I think there was an expectation that it would come down more than it did. We're still above 8%. And obviously, consumers out there and investors are worried about an economic slowdown, perhaps even a recession. JT, can you talk us through what are the components of inflation, and is it actually all supply chain?
Yeah, that is the elephant in the room for sure, Holly. And it is interesting to reflect that little over a year ago, inflation was still very nascent. You can look at this chart and see on the far left there that as recently as March of 21, inflation was very modest, just slightly above the long-term target of the Federal Reserve. And it's really ballooned out. And it is interesting to note the correlation in timing that coincided not only with the advent of the vaccines and a push toward reopening, but it also coincided with the most recent stimulus under the Biden administration taking the reins there. And so it's noteworthy that maybe in contrast to Dennis's analogy, that we were applying perhaps adrenaline or nitroglycerin to the cardiac patient just as it was beginning to revive, perhaps. And so that certainly fanned the flames of inflation even more greatly. We had significant stimulus applied at the very end of the 2020, and then also obviously early in 2021. So it is certainly about a lot of supply, but it is also about the composition of demand, and demand really reinvigorating with the opportunity to reopen for folks to get back out into the world and re-engage in normal behavior, if you will. And you can see that surge take place, but supply chain was a huge contributing factor. So the post-COVID, the lockdowns, the impact on a lot of our transportation and logistics sector, the inability to get raw materials, that was a big part of the new and used vehicle, the great increase in the red component of inflation there. But also you can see in the light blue down at the bottom, the restaurants, hotels, and transportation. More recently, as you scan across, you'll see food at home. So that was a growing issue even before the Ukraine invasion took place here in more recent months. But what's really important to recognize here is after that initial surge, so say from March through June or July of 2021, you can see a lot of the increase took place during that period. The new and used vehicles, the energy component, the shelter component. So a big part of this so-called base effect had taken place. And so when you're measuring inflation, you're measuring it year over year. So April 2022 versus April 2021, for instance, now we have a lot of the inflation factors sort of already, the step change, if you will, has occurred. And so when we're measuring now, say August, September of 22 versus August or September of 21, we may see significant reductions in that headline rate. It may not mean that prices are going down, but their rate of change, their rate of increase is likely to significantly step back.
Yeah, that all makes sense. And again, just to clarify, the base effect, I think what you're saying, JT, is that when you start so low, like we did when we shut down the economy, you expect to see a huge bump up, right, when you open the economy. And so that doesn't really count, if you will, as normal inflation.
Yeah, it's hard to say what counts. Obviously, it hits the consumer mood significantly. And these headlines, we're confronted by them every day as we go by the gas stations, right? But you're absolutely right. That rebound effect, it's kind of a pendulum. If you think about maybe the old analogy of the inchworm or the roller coaster, during COVID, we shut down so much, inflation actually went significantly negative for a time. So if you measure inflation over a longer frame, a longer than, say a 2 or 3 year period, if you look at the cumulative inflation, maybe since early 2020, late 2019, pre-COVID, you'll see that the annualized inflation rate over that full period is a lot more modest, in the 3% territory.
Yeah, that makes sense. Even so, as you alluded, it's not easy going to the gas pump. I filled up my car the other day and it was $80. So that people are really feeling that. And I know that it impacts consumer and investment sentiment. What do you think the impact is on the consumer and on a potential market changes just based on consumer sentiment?
Well, clearly it's not good. This is a significant effect on how people think about their prognosis, their opportunity. So it factors into their spending decisions. The old adage about inflation taking root in consumer expectations. And so when you think that that will put a crimp in your willingness to consume due to the inflation piece. I think it is worth noting that every individual's inflation mix is a little different. You may have noted on that prior slide that the rent is a pretty significant component of the overall inflation. So the shelter piece is a pretty significant component. Obviously, if you own your home, you're not affected by that. You're not actually impacting that. So, if you decompose the overall consumption base in the U.S., it really disproportionately impacts perhaps those who have the least resources to adapt to it in many ways. But yes, consumer sentiment, I guess if you go on to that next slide, the savings rate, this one's particularly interesting. Looking back over the long term, you saw savings rates decline steadily from the mid-70s, the last phase of really robust economic growth combined with growing inflation. Savings rates declined all the way up until the housing and financial crisis in 07, 08. It then surged. Maybe we got a dose of medicine, or that we really needed to have greater savings. And temporarily really shot through the stratosphere as a result of a lot of the transfer payments that were being made. But it has fallen back down closer to the, quote, new normal, the post-financial crisis range. We do think that it is going to likely stabilize there, but this surge of adrenaline that hit the economy in that short-term savings rate has likely come down. Now, there are a lot of reasons the consumer is still pretty resilient. If you think about so many folks who are homeowners having the opportunity to refinance their mortgage perhaps several times over recent years. So they have reduced the total share of their spending that has to go to debt service pretty significantly. So there are reasons to think that we may still weather through it. But yeah, inflation's a huge burden on a lot of aspects, a lot of consumers in our economy. I think it's the classic, is it half full or half empty sort of question. Inflation at 8.3% is painful. It has begun to trend back down a little bit. Many employed folks are seeing wages increase substantially at the same time. So the real gap is probably only 2 or 3%, but it's still a gap.
Yeah, and I know it's hardest on families that don't own their homes. I recently saw a trend where people who had been paying $1,000 a month were suddenly asked to pay $2,500 a month, and obviously had to vacate their homes. So it's definitely not good for those who don't own their homes, weren't able to refinance, and some of the stimulus impacts have now been spent. A lot of people saved a lot of money during the pandemic, including professionals, because we weren't traveling, we weren't eating out. And so some of that is starting to wind down now.
Well, Haleh, to that point, the Federal Reserve Bank of New York did a survey recently, and consumer expectations of rent increases over the next year averaged 10.3%. That's their expectations of the coming year.
Yeah, that doesn't bode well for consumer confidence or spending, does it? Well, PJ, I saved the best for last here because I'm going to ask you to speak about equity markets. That is something that all of us I know are concerned about. We've seen a precipitous decline this year. What do you see happening going forward? I know that I have clients who, some of them want to go into the market and buy the dip. Other ones want to rebalance their portfolios and sell out of stock. So what do you think?
Happy to discuss that, Haleh. On this next slide, what we're really looking at here is current valuations. And if we flash back, for those of you who were able to join us back in mid-January, We had numbers as of January 14th. And so when we looked at this exact same chart back then, the valuations were obviously much higher. It was before the pullback. But here you see a long-term average over the last 25 years, price to earnings ratio. And again, that's looking at what the current price of stock is per unit of earnings. And it's really kind of a valuation measure that many use to think about where we're going. Because whenever you buy a stock, you're really buying a piece of the future earnings growth. And so you want that E component, the bottom component, to grow. And as it grows, hopefully the price will grow as well. But if price doesn't grow, it's making things cheaper. Obviously, the other thing that can happen is that the E falls, making things more expensive. So here you can see right here at the end that based on the pullback year to date, which is in the upper teens, that we're around 16.5 price to earnings ratio, looking at the expected earnings over the next year. And that is right in line with the last 25 years. When you look in the middle box at the top, you can look at a number of other types of valuations. We won't go into all the details here and get down to the minutia of each one of these, but you can see that they're all currently within one standard deviation of their 25-year average. If we flash back to January 14th, every single one of them was above one standard deviation, with that price to cash flow, the second from the bottom there, being over 2 standard deviations from the bottom. So again, things have gotten cheaper. Not surprising, the market's come back. Now, what we need to think about going forward is really that earnings component, because in order for valuations to make sense now, we need the earnings to grow and the stock market obviously to reverse course to begin to rise again. And what we're seeing is mixed signals on that front. When you look at some recent earnings reports from 2 of the larger big box retailers, they did not meet their expectations and their outlooks were not very positive. And again, the stocks declined on those days when they discussed their earnings reports. Again, how much of this is, again, just a flow through effect from the fourth quarter? One thing we haven't touched on yet is that the GDP growth rate in this country, in the US, during Q1 was negative. That was a surprise. The blame that many have attributed that to is the fact that many companies ramped up their inventories in the fourth quarter, potentially seeing another supply chain issue coming, and spent a lot of money, which helped GDP in the fourth quarter. But then that inventory, they didn't redo that in the first quarter, along with the fact we had the Omicron variant ripping through many parts of the US. And so again, we had a negative print or a negative value for GDP growth quarter over quarter in Q1. Many view a recession as 2 consecutive quarters of negative GDP growth. So here, when we get to July, we'll get a number for what the second quarter in the US did. Again, if that's another negative number, then you're going to start hearing the recession calls a lot louder. Even in the past few weeks, you look at some of the larger Wall Street firms, you look at some surveys of consumers across the country, inflation being the #1 concern, that also people are associating that with a coming recession. We all know one is coming. They always are. We just don't know the duration from today until that time comes. And like I said, we could always already be in one. But what we want to talk about is looking at kind of continuing with that discussion of consumer sentiment. And there's a slide here that's discussing the Ned Davis Research Crowd Sentiment Poll. And it's looking at a composite of a variety of sentiment indicators. I think it's the next slide. Thank you. And so here, what we're looking at is really the last couple of years of how Ned Davis has calculated this poll, and looking at where is there extreme optimism. That's when the blue line is above the yellow dotted line, or extreme bearishness, or extreme pessimism, which is when it's below the yellow line. And you can look at the past 2 bear markets we've experienced. 2018, the fourth quarter, you may remember, is really quick. The Fed was hiking into what may have been a slowdown in the economy from we're having our issues with China and tariffs and lots of discussions back then. But the Fed was hiking into that. They hiked maybe one 25 basis point hike too far, where the markets couldn't stand it, and they quickly reversed course. And so you had negative sentiment building into that fourth quarter. The market was falling, and then when the Fed announced they were going to reverse course and kind of plateau, and then again re-engage with quantitative easing, again adding funds to the market, buying bonds, it's supporting the markets and the economy. You see a quick reversal in that. Again, 2020, we know that extreme quick pessimism was caused by shutting down the economy associated with the origins of the COVID-19. So again, here we are. Both those times were associated with very good buying opportunities in the equity markets. Here we are, we're not quite to the same pessimism that we saw back in late 2018, but we are getting there. Beyond just the Ned Davis poll we're looking at here, other ones that are broadly quoted, there's a Michigan consumer sentiment poll currently sitting at a decade low. There is the American Association of Individual Investors. They do pollings of their members looking at bearishness and bullishness. Currently, we're sitting around 50% bearishness, a number neutral, and not very much in the bullish camp. And typically, many believe, and data has shown in many instances, that these are contrary indicators. So, if you think back to that Warren Buffett quote that many of us have heard, be fearful when others are greedy, and greedy when others are fearful. Across these three polls we've discussed here, there is a lot of fear in the market. Now, a lot of it is warranted. When you think of, we are seeing inflation that we haven't seen since the late 70s, early 80s. We are seeing a Fed hiking aggressively with the last two hikes, saying they're going to continue to hike with the goal of getting inflation under control. Again, they may be a little bit behind the curve and haven't gotten started on this, but they do appear to be intentional about getting it under control now. Now, what does that mean for the markets? Markets are typically forward-looking. Economic data is backwards-looking. So when we're getting, whether it be inflation prints, whether it be GDP, whether it be what this morning we got housing data for April. Again, Haleh mentioned how much more expensive a mortgage payment's gotten with the rise in interest rates. The housing data this morning missed by a wide margin the consensus estimates in terms of new home sales. And so we're looking backwards. The data is not looking great. But again, the question is, and none of us know the answer to this, is when are we beginning to turn the inflection point? And usually the markets turn before the all clear is shown in the economy, since most economic indicators are lagging. And again, one more thing on this slide here is that talking about the actual returns, if you go back to 1995, you can see that when the blue line above is below the either the dotted yellow lines, but really below the bottom one where we are today, that the market trends over the next year have been positive. Again, when you see the extreme bullishness, when we're above that yellow dotted line, you can see that we've been pretty flat. So even in a bullish market, it's usually gets up there at the extremes, maybe like a .com going into 99, 2000, 2005 and 6. So again, we're not saying that we think we've hit the bottom and that there's not more economic pain coming in terms of the data we see. We don't know if we're in a recession now. We could be. We may not enter one for 18 months. But typically, when you see these sell-offs and you see the bearishness become widespread, it's not an opportunity to go all in and push all the chips in, but it's an opportunity to take advantage of this and buy a lot cheaper than you could, 6 months ago. And you may get. We hope we don't, but there's a decent probability that you'll get another chance to take another bite of the apple here in a couple of months. We're going to show a slide in a minute that kind of shows, here it is, thanks for pulling it up, that if you do not perfectly time the bottom of the market, usually there can be a big gap in terms of your performance coming out of a bear market. And the reason for that is that usually when you do bottom out in a bear market, and the tide turns and investor sentiment turns, you do get a sharp bounce. So those first few months can be very strong. Before I go into describing this slide, I think that the key we all on this call want to make sure is that the principal component that needs to be established up front for each investor is that they are in the right risk tolerance, meaning just thinking broadly, how much do you want in risk-bearing assets such as stocks versus how much you want in cash and bonds. And again, notwithstanding this year, bonds have typically been a solid ballast for your portfolio. But if you have to get that right, because again, if you're in 100% stocks and the market is down 20 or 30, at some point, some people can't take it anymore from a psychology perspective, and that's completely understandable. But throwing in the chips and cashing out near the bottom do long-term damage to people's financial plans. And so we do want to make sure that, again, if you have questions or concerns about are you in the right risk tolerance, please reach out to your advisor. So that is the one thing before I talk about the slide that we want to be key on, is that you got to be at the right starting point for this slide to really make sense. But what this,
I think, PJ, if I could just interject, because I know we all have clients that are somewhat anxious and potentially wanting to scale back risk. So our counsel to them, if they can hang on, is it's generally not a good idea to de-risk when the market is down, if you can do it. And the reason for that is you're taking unrealized losses and turning them into realized losses. And that has a refractory impact over the long term because of compounding, right? And so obviously you've got to be able to sleep well at night, but and hopefully you remember from this experience that, you know, I didn't want to be that volatile. I didn't like that. So when the markets rebound, we could sort of readjust the portfolio without economically harming your financial situation if you can manage it. Again, obviously call your advisor if you're having difficulty with your risk tolerance, and we can kind of get you there in an economically savvy way, let's just put it, to the extent possible.
That's exactly right, Haleh. And again, the starting point matters. That starting allocation matters. Are you where you should be based on where you are in your own life, where you are from a your financial plan perspective, but also where you are from a behavior finance ability to sleep well at night. I mean, we think that is so key in all this, is ability to sleep well when the markets are volatile. We show a chart pretty regularly that talks about over the last 30 years, I believe it is, the median decline in a given year, 13, 14, 15%. Yes, there's some years where it's much more than that. You look at a dot-com bubble in 87, a 2007, 2008. But historically, and again, it's all looking at history, we can't predict the future. The bull markets have lasted a lot longer than bear markets, even though when you're in the bear market, it feels like it's lasting forever. But when you're looking at this chart, what this is saying is going back to 1970, depending on who's calculating it, we've had 7 or 8 bear markets, so 20% plus declines. Today, we may or may not have closed in one. We came close on Friday intraday. We were down 20%, but we closed higher. Today, we were down a lot more during the day. So we haven't, depending on who you're talking to, we're close to a bear market here in 2022. But looking at those last 7 or 8 back to 1970, if you were in 100% stocks at the bottom, you can see your successive returns, 12 months, 24 months, and 36 months from that bear market bottom. So in 12-month period, 46% has kind of been the average, 24-month, 70, 36-month, 83. If you were, you went to cash at the bottom, let's just say, or you had cash on the sidelines that you weren't willing to invest at the bottom, again, they don't ring a bell at the bottom or the top. But if you were in cash, T-bills here, just think of it as cash, for the first month after the bear market bottom, you can see what your returns were over the 12, 24, and 36-month subsequent period. And you can see that is a large gap in the returns, 25% versus 46% versus 57%. You compare that to 46, 70, and 83, and you have a 20% plus gap in each of those situations. If you look at 3 months after, 6 months after, again, this is just saying that when things turn, they sometimes and often do turn very sharply. Now, we know one of these times was COVID, and we understand what happened in COVID in terms of that quick turn. That bear market lasted only 33 days. We were down 34%, so almost twice where we are now, but it only lasted 33 days. And you contrast that with the longest bear market over the last, going back to 1970, was the dot-com. During the dot-com bubble, the bear market lasted about 930 days. With a 50% decline, similar decline in the 07-08 recession. On each side of that, in the 90s, obviously a great decade for investing, almost 4,500 days in a bull market. After financial crisis in 07, 08, 09, we had 4,000 days in a bull market. So again, the bear markets are very painful, but trying to trying to time the bottom, if you're late, think, you tried to get out because you couldn't take anymore, and then bottoms, and then you don't get back in until all the sun is shining, that typically can create a gap. Again, some people, their financial plan allows for this, their psychology is what makes sense. So we completely understand some not wanting to ride everything out, but we believe that if you're in the right risk tolerance starting out, and we build diversified portfolios that typically trying to go all in, all out of the market around the peaks and the troughs is very difficult. And if you don't call it correctly, you can see the gaps that can be created in your long-term performance.
Yeah, thank you for that. I think the moral of the story is if you can write it out, it makes sense economically. Again, and I forgot to mention this at the beginning, but if you have questions, please type them into the Q&A box. You can also reach out to your advisor for more personal questions. But I think all in all, we would say that attempting to write it out is what makes sense for most people.
And Haleh, if I may, we had a good discussion this morning on our investment committee that if you can even be a little opportunistic and bump up your savings rate or something along those lines, obviously being able to reinvest after a market is down 15 to 20% is generally quite rewarding. I can't say whether that'll be true in 6 months or 9 months, but over the next 3 to 7 years, your opportunity to step in and be a buyer when others are fearful is generally a very rewarding strategy.
Yeah, and we have people with cash on the sidelines right now that are dollar cost averaging. So we don't know where the bottom is. Maybe they put in X dollars today, maybe a month from now they do another X dollars. But generally speaking, as you just alluded, JT, market downturns are opportunities. It's the only thing that goes on sale where people run instead of buying, right?
Yeah, and I just like to make a comment on that one as well, that we've been through many bear markets. We've been through many just normal downturns. Bear markets, a lot of people tend to stop putting money into their 401k at the same level or 403b. And again, you should overcome that thought process, and instead of cutting it in half or down to zero, as JT mentioned, maybe double it. and that has been a winning formula every single time for the last 30 years.
Yeah, good reminder, Dennis.
Just building on that a little bit more, Haleh opened the discussion with the note that essentially all the liquid asset classes are down 10 to 20%, and that is quite unusual to see that degree of correlation, if you will. But I think that, as we referenced, by being underweight bonds, by something we're going to talk about in a minute, using alternatives, our portfolios have done a good job of playing a little bit better defense. So I think client experience has perhaps been a little bit better than might be expected, given some of those benchmarks. And we are trying to take advantage of some opportunities along the way as we can. So, again, I think keep your context in mind, that hopefully you've prepared in advance. And I think a big takeaway is that, as painful as this is, because of that correlation that is unusual, except at the end of business cycles when interest rates are going up, it actually has not been terribly severe thus far. And that may be small solace, but if you think about the typical history, is that in average year in every year you see an average decline of 14% somewhere along the way. So we're a little bit more than that right now. We're significantly more and more of the growth, more of the frothy areas that got so much investor piling in behavior over recent years. But on the whole, we're at 18 to 20% versus that average of 14%. So not yet that extreme.
And just another reminder, I find people look at the markets and they're watching CNBC and it says we're down 20% and they think their portfolios are down 20%. Most of our clients are very well diversified. You're not in 100% stocks. So to the extent that you have other asset classes, and not just bonds, but other alternative investments, which we have incorporated into our portfolios, you're actually doing quite a bit better than that, right?
And I guess this slide is the perfect example therein, right?
That's right. Why don't you explain this chart, JT, if you would?
And PJ, I think you were working on this one as well, but effectively this is showing the triangle in the bottom left and the top right Those are the traditional asset classes of US bonds and the US stocks. And what this is portraying is vertically the return, horizontally the risk, the volatility or standard deviation. And so if you are invested strictly in stocks, you had high returns but high volatility. If you're invested strictly in bonds, you have low returns and low volatility. And the gold circle is you did the sort of the classic early retirement style investment of 60% stocks, 40% bonds. What this chart is really portraying is that all of those other little symbols there represent private real assets of various types: farmland, infrastructure, real estate, timberland. Those collectively have exhibited some real nice benefits in diversifying portfolios over the last 30 years, wherein they have returns similar to or better than that 60-40 portfolio with a good bit less risk. So adding these in has done a significant job of, in CFA parlance, bending the risk reward curve, giving your diversified portfolio a better risk reward. So obviously the future is the past is no guarantee of the future, but we continue to really like the benefits of having more of those private real assets in portfolios. It's been a big benefit over recent years, as we alluded to earlier, by having a lot more in these categories and about half the weighting in bonds. Having 20%, for instance, in real assets that were up 2 to 5% over the last year instead of being down 10% in bonds is a real obvious benefit.
Yeah, that's right. And a perfect segue into what we're going to talk about next. As clients, most of you know that we regularly create scenarios. There are a lot of wild cards out there right now, as we just discussed. Inflation, rising rates, consumer sentiment, a war in Europe, Fed rate hikes. So we look at various scenarios, and while that's helpful, it's not a magic crystal ball. But we do find it helpful to extrapolate different scenarios and then look to what would we do in that market environment. And so given all the uncertainty today on what's going on, we decided that it might be useful to walk through 3 scenarios that we've developed, the weighting that we're giving to each, and also what the impact of each scenario would be on various asset classes. And for this, we're going to have our expert scenario planner, Dennis, review for us, if you would, please.
Yeah, thanks, Haleh. We're in one of the more complicated scenario situations that I've been in my career, which is saying a lot considering the 08-09 downturn was pretty darn complicated as well. And so our base case, our most likely case, is that over the course of this year, the primary fears ease. The primary fear that inflation is going to stay at 7 or 8% for a prolonged multi-year period of time, that the Federal Reserve is going to have to go Paul Volcker in terms of raising interest rates to some outrageously high number, crash the economy. That fear will ease, and investors are likely to relax in that scenario. And again, somewhere along the way there, a lot of the stocks that have been hit pretty hard are going to have some sustainable rallies. We've seen a lot of up and down lately. And so the base case, this is one that our key research providers are feeling is pretty good bet, but not at enough to go all in. Back to PJ's comment, there is not that high enough conviction that all of these factors, that something goofy won't go on. Now, I will tell you that a few of our top research outfits believe, that looking at all the things that have snarled up the energy situation, whether it's the Biden administration, some of the things that they put in place early on or took off the table, whether it's the Ukraine war, whether it's some of the other factors, a lot of this stuff, maybe excluding what's going on in Washington, is going to ease up in the next 6 months, and that oil prices will come down, energy prices will come down. But even that piece, you know, in a slowing economy, we ought to see some of that happen, but there's other crosswinds right now. And so that kind of gets us into this wild card destabilizes scenario. And Haleh, you want me to forge into that one?
I was just going to say the wild card destabilizes scenario just seems like everything that we've got going on just gets worse, essentially. Did you touch on what would happen in the base case in terms of the various asset classes? So we expect stocks to kind of normalize a bit, and you know, what about the alternatives in that scenario?
Yeah, stocks would more normalize. There would be a potential increase in, again, if interest rates are increasing but not as much as most people believe, then companies that are cash machines, and you'll hear that comment a couple of times. This is a primary top 5 theme: cash machine companies, ones that have pricing power, ones that have the ability to maintain their profit margins, well-managed companies that will be increasing their dividends. Those kinds of companies, you know, will do fine. But again, if interest rates aren't going to skyrocket, the big growth companies that have been heavily discounted here lately, they're going to also see some better times. The alternatives, we still believe real assets are a great alternative. The infrastructure, agriculture, timber, we're actually in the process of further increasing exposure in 3 of our different objective and risk levels, taking money out of cash and in some cases fixed income into that area. We had a great research call recently where all 3 of those areas are hitting on all cylinders, and they're actually up this year, and they do a fairly good job of hedging inflation as well. Regular real estate, we own a lot of real estate in SFG, from low leverage to high leverage to all kinds of different ones, multifamily. You know, there's an estimated 4 to 6 years before supply of multifamily will catch up with demand. And so, you know, the number of renters in this country is huge, and we have Gen Z coming out of college and making fabulous incomes in general because of the labor shortage, and most of them can't afford a home. So the millennials are kind of mixed, you know, some are renting, some are buying homes, but the Gen Z, at least so far, most of it is renting. So that area looks like it will continue to do pretty well in the base case scenario. Some of our other alternative, private credit, private equity, venture capital, which in our case, we concentrated a little more in healthcare and some other areas. Those types of investments still look pretty strong because of the trends that overwhelm and overpower all this noise that we're hearing right now. Now, where this gets tricky is in the wild card destabilizes, and depending on which wild card comes into play, you know, we've just listed a few of them here. We sort of did monkeypox in tongue-in-cheek because most of the healthcare experts, including one of our clients who's right in the middle of the research on this right now, do not believe monkeypox is going to become this huge new COVID thing. But you never know. That's why they call it a wild card, right? Most people would say Putin is a wild card. It seems less likely he's going to take on NATO, but we don't know that for sure. Inflation, as you've already heard, there's a lot of messy bits with inflation. We've had meetings with a number of business owners lately who are experiencing all kinds of weird effects from inflation. And again, some of them are supply chain shortages as much as anything, but some of them are just downright inflation. And they don't necessarily think this inflation in some of their key supply chains will continue at the excessive rates they have in the last few months, but they are worried that it'll be above trend going forward. And then we've already talked about that Fed overshoot piece. That is a persistent fear in the marketplace, and we don't know for sure. We don't think it'll happen, but we don't know for sure that the Fed won't go all Paul Volcker and raise interest rates to a radical place to try to kill inflation or tamp it down. And so these wildcard destabilizations creating substantial turbulence come right back to the comments that several people, PJ, JT, and Haleh, have made on the fact that we need to make sure that folks are where they need to be on the risk tolerance. We need to make sure that if particularly they're in withdrawal stage, they have enough cash to get them through. We've had several meetings with business owners where they're not in withdrawal stage. They're in accumulation stage, and many are in their 30s and 40s. But because they're having so much stress at work in their business, they are keeping higher cash balances just in case and to help them sleep at night. Well, their business is the highest return thing they'll ever invest in generally. And so being able to keep their eye on the ball, pretty important.
Yeah, and I might just interject here also for those that are potentially considering retirement. I know we've talked about the Great Resignation, so on and so forth, that it would be really great before making any major moves to have your financial plans updated. You know, let's look at your financial plan before you decide that you're exiting the labor force, or before you decide to buy X or sell Y. Let's just make sure that it doesn't destabilize your portfolio as the wild card destabilizes the economy, right?
Yeah, and you know, we've just had conversations this morning and frequently lately about some of the things we do well at Stearns Financial, which is fire testing those roadmaps. And, you know, we have special scenarios for fire testing some of those. We don't have a monkeypox fire test right now, but for a lot of the other scenarios, you know, we can fire test it just in case.
Well, fortunately, it looks like the base case currently is the most likely, but as you say, Dennis, there's not enough conviction surrounding that we just want to assume that's what's going to happen. I guess the other scenario to look at is the stagflation scenario. And for those of you out there who may not know or remember what that term is, it's basically a period of high inflation, but low economic growth. And so stagnant growth, in other words. Tell us what we would do in that scenario, Dennis. What does that mean?
Yeah, so there's a lot of different flavors of stagflation. So everybody's probably going to hear this term more and more in the next 6 to 12 months. And the concept is slowing growth. Maybe it's not slow enough to actually be a true recession, but slowing growth combined with above trend inflation. We're not talking 7 or 8% here. We're talking 3 or 4% above what has been the trend inflation. You get to a point where the two of those are more equalized, and it's like you're spinning your tires in mud, and you're not making a whole lot of progress relative to purchasing power and inflation. So there are light stagflation scenarios. There are heavy stagflation scenarios. Again, this scenario suggests not necessarily that it'll happen. I mean, we do expect slowing growth, and we do expect above trend inflation, but we don't necessarily think that really nasty multi-year stagflation is going to happen, but just the potential. We're living that right now, where the market is having hissy fits over things that haven't happened yet. Fears of what could happen in the next 6 to 12 to 18 months. Well, what if there's fears of the worst stagflation? And again, that's one of those where I think there's going to be some difficult volatility in the stock market. Again, I'll tell you what we think will work and won't work. And again, depending on whether we think it's going to be mild stagflation or heavy or stagflation at all, it may just be slower growth and above trend inflation. And we're back to the mid 1990s, by the way. So in this environment, stocks are going to be probably lower returns, but I'll go back to the cash machines. Those companies that are cash machines and can grow their free net cash flow will grow their dividends by inflation or better. You know, we use several managers today that's their number one focus, is companies that will grow by 1 to 2x inflation their dividends over the next 5 years plus. Those cash machines, companies that really have good pricing power for their brands, for what their people are buying, those will power through. Now, maybe again, they won't make long-term historical numbers, 10, 11% kinds of returns, like we saw on the chart a little bit ago, but they would power through with positive returns in most cases. Some of the big growth companies might struggle in this environment, but again, if they're companies that have set up business divisions that have tailwinds with big trends helping them, gaming comes to mind with several large companies. And so those companies are likely to power their way through what, again, for a lot of growth companies could be a pretty messy environment. And then you get down to commodities. Commodities generally will do well, but again, the traditional commodity fund often has 20%, 30%, sometimes 40% in oil. Well, what if all those estimates from bank credit analysts and others are correct, that the cure for high oil prices is high oil prices? We've known that for 40 years. And that some of the things that are going on in the United States, there's an estimate that a lot of our gap in production of oil is going to decrease within the next 6 to 12 months radically. And that's a result of a whole variety of things going on. And so in this kind of environment, you want to be able to have commodities that tie into what companies and consumer demand are doing. And so a number of the managers we work with, for example, are in the supply chain of electric vehicles. Well, that's a trend that's not going away, and is going to be pretty big in the next 5 to 10 years. And so part of the thought process here is whether it's gold, which, by the way, probably will do well in most stagflation scenarios, or whether it's real assets, agriculture, timber, infrastructure. Those things are likely to do better than average. And again, that's part of the reason we're adding that to the equation. We have kind of a tails, we make some money, and heads, we make even more money with these scenarios, with that real asset area. Okay, that's a good thing to lean into more in this kind of uncertain environment. I will also say, just to kind of wrapping up, that private equity, venture capital, in fact, let's go a couple more pages in here to the different asset classes.
Oops.
Oh.
Not there right now, but perhaps a good segue, Dennis. There you go.
Yeah. So you know, we've talked about a few of these in that stagflation scenario. Again, some of the high growth stocks are going to have challenges, but robotics and artificial intelligence is one of the most powerful trends of our time, followed closely by genomics, I might mention. So which of those would overpower which? Not sure. You know, maybe they go sideways for some period of time in stagflation. Go to the next page. So again, real estate, low leverage, high leverage. Some of our research sources suggest those would continue to power their way through. Others are saying, well, if interest rates get too high, it's going to create some valuation issues. So that one's a little bit, you know, kind of in the middle. Infrastructure, agriculture, timber, we talked about. Gold, we talked about. Go to the next page. So commodities, again, possibly excluding oil, but commodities could be pretty interesting. Private credit could continue to be very good. Private equity, particularly for those companies that are making their own weather patterns with companies, you know, creating growth opportunities for companies they partner with, have some pretty interesting prospects in a stagflation environment. Multi-sector private equity, again, diversification is a good thing for most people. And so that ought to do fine in stagflation. And venture capital, again, it depends on where you are in venture capital. If it's healthcare, boy, we need a lot of innovation in healthcare in the next 5, 10, 15, 20 years. And the kinds of things we're seeing are just incredible. Just incredible. I mean, again, they're underreported, but every single week, it seems like we're hearing about from our network of healthcare professionals, scientists, venture entities, private equity entities, something new and interesting. And so the fact is that if you're in venture capital in companies that for whatever reason don't have pricing power, or they're subject to, you know, certain parts of the industry, retail maybe will have more difficulty in certain stagflation environments, those venture capital funds will suffer. So again, I think the bottom line, Haleh, is that even in stagflation, you know, I just actually said that over half of the things we have on this long laundry list of options may do okay or better than okay. So the good news is we have a lot of tools in the toolkit, and as usual, we will try to adjust those tools depending on the circumstances we see ourselves either in or going into.
Yeah, and that's a good reminder, Dennis, that I think it was Warren Buffett who said the only free lunch is diversification. And so I think our theme going forward, because it's difficult to know, if we've not learned anything in the past 2 years, it's that you could not predict a pandemic, right? And so it's very difficult to know with a high degree of accuracy what we think might happen. And the solution there is to have a disciplined asset allocation that's well diversified. Often low correlations help with that. We're in an unusual time with stocks and bonds right now, but PJ, is one of the heads of our investment committee, would you please like to describe our diversification themes in our portfolios today?
Yeah, and I think, and we've touched on a lot of these today already, and I think Dennis hit on them the last couple of slides, but we really are focused on diversification depending on your risk tolerance. It's different levels of diversification. And really focused right now with where we're at on those high quality assets with high quality earnings. We talked about earlier that valuation multiple going forward, the earnings need to continue to meet or exceed expectations in order for, you know, prices hopefully to rise while valuations stay reasonable. You know, if we do, you know, turn the corner and the market goes way up, but these earnings don't catch up and don't keep up, you're going to be right back to where we are with a very high P ratio that people become very worried about very quickly as you look out to the next stream of earnings. And so Dennis talked about many of the behemoths in the indices, both here and abroad. They have war chests, they're trading at reasonable valuations. They have products and services they're offering that are and will continue to be in demand. And so we want to be invested in those companies that do have those quality earnings that can be sustained, the dividend can be sustained, and have quality balance sheets behind them to weather any further downturn. If we actually do, hit a recession in the next 6 to 12 months, that they can withstand it and continue to provide high quality products to their consumers. On the inflation protection side, we can't have everything in the portfolio protect against inflation all at the same time. But as Dennis talked about, we do have large exposures to both real estate and real assets, which should, in many scenarios, do well in this higher inflation environment. Again, there's other parts of the stock market that may do okay, as Dennis mentioned. But again, inflation will obviously hurt cash. It will hurt bonds if you're the owner of the bond. And then low correlated investments. That's the point of diversification, is that you have assets across the spectrum that some are correlated, some are not correlated. And so that, again, this year we have seen declines in the bond market and stock market. That has not typically been the case. It may not be the case going forward. But while those have been going down, you've seen gold go up, you've seen real estate continue to show signs of going up, and we have seen the real assets go up this year as oil's gone up, as wheat prices have gone up, and some other hard metals. So again, we just wanted to continue to preach diversification, and that's how we'll continue to manage the portfolios.
And thank you for that, PJ, and to the rest of our panelists, Dennis and John. And thank you so much to our audience out there for tuning in. Again, if you have any questions specific to your own situation, please don't hesitate to reach out to your advisor, or any one of us would be delighted to talk.